Hello everyone and welcome to this quick fire revision for AFM where we try to complete the entire subject in 1 hour. This is particularly helpful especially before your preparations where you do it in detail so that you are very much refreshed on the entire concepts. The entire subject seems familiar and you go for your 1.5 day preps. So over here we are going to discuss all those descriptive topics, all chapters, all adjustments. We'll try to complete this within 1 hour. We will do it at 1x, you can obviously do it at 1.5 and your favorite 2x speed and maybe get done in less than 30 minutes. So let us get started. First we go to the chapter on security valuation. Here you have various items that you try to value like bonds, shares, rights, convertibles, etc. First is fixed income securities, that is bond. The value of a fixed income security or a bond is calculated as the present value of all future interest and principal payments discounted at, if I am valuing from the investor's perspective, discounted at the required rate of return for the investor, and if I am valuing it from the company's perspective, then the required rate that the company wants to give to the investor for the purpose of determining issue price. Further, a few important relationships that you need to remember for the purpose of this workings. The relationship between coupon rate and the discount rate or market rate of interest. The coupon rate, if it is greater than the market rate, the bond will trade at a premium that is greater than face value. Coupon rate is lower, the bond will trade at a discount that is at a value lower than the face value. But most importantly, from an exam perspective, if the coupon rate is the same as the market rate, the bond trades, the market price is the same as the face value. Now over here, words like discount rate, market rate of interest, yield to maturity, all of these are generally used interchangeably. Similarly, words like intrinsic value, market value usually are used interchangeably unless the context of the question tells you the other way around. Usually intrinsic value is calculated as the present value of future cash flows, and if the market is efficient, intrinsic value is the same as the market value. Okay, another important relationship before you proceed is the relationship between the bond price and the rate of interest, that is inverse. So if the market rate of interest, that is RBI, reduces the market rate of interest, the bond price goes up, and vice versa. If the market rate of interest goes up, the bond price goes down. Next is the measures of return. There are three measures of return. First is the current yield, that is interest upon price. This is the most crude measure, and the drawback of this measure, it excludes capital appreciation and it also excludes the time value adjustments. Second is realized yield, where you use the compound interest formula, where you say that the total proceeds that you receive, that is interest plus the principal value, should equal what? Well, it should equal to the price into 1 plus rate raised to n, where r can be found and that r will be the realized yield. Again, this considers probably the capital appreciation, but it ignores time value to a very great extent, and hence the best measure of return is considered to be IRR, which is the yield to maturity, where if I were to buy the bond today and if I were to hold it till maturity, then what is the return I will get is called as the yield to maturity. Typically it is calculated using the trial and error interpolation IRR method. Next, there is something called as a forward rate. Forward rate over here are rates which are expected to prevail, let us say in the second year or in the third year. YTM gives you the average rates, forward rates gives you the exact rates which are expected to prevail in a particular year, which can be calculated by 1 plus YTM squared is equal to 1 plus R1, that is rate of the first year, into 1 plus R2, and that is how you can imply the forward rate and use that, let us say, for the purpose of interest rate forward in interest rate management chapter. Okay, then you have a measure of bond risk, which can be measured by something called as Macaulay's duration. Macaulay's duration is nothing but the time based weighted average. It is like the average due date or payback period concept, where you take summation of t into the present value of cash inflows upon the summation of present value of all cash inflows. That will give you the Macaulay's duration, which is a measure of risk which will be used for the purpose of let us say something like a modified duration. So when you look at a modified duration, this is the volatility, this is something similar to beta, which we use for the purpose of measuring the sensitivity of the bond. So modified duration is calculated as Macaulay's duration upon 1 plus the existing YTM. If you want to find the bond price considering the duration statistic, then you will take the percentage change on the interest rate into, let us say, 1% change in interest rate, the change is going to be modified duration. Then for a 0.5% change, it will be how much? Remember, the relationship is inverse. Further, you have something called as convexity, but before you go to convexity, one needs to remember that for bond strategies, if you are holding, let us say, a longer duration bond, and if the rates of interest go down, the values of longer duration bonds will go up, and hence you will buy more and more longer duration bonds. However, if the market rates of interest go uh, go up, then the bond prices will fall. You will sell the longer duration bonds and invest money in safe assets, probably the shorter duration bonds. So over here, next you go to convexity. Convexity can be calculated as a derivative of duration. So as interest rate changes, the duration itself undergoes a change, and the rate at which duration changes is measured by convexity. Typically for measuring convexity, you will find a value as compared to the current rate. You will increase the rate by, let's say, 2%, decrease the rate by 2%, and then apply this formula that you see on your screen. That will give you a measure of convexity. Convexity is not as important from an exam perspective as duration is. Next, you go to immunization. It is a process of interest rate management where the duration of bond assets should equal to the duration of bond liabilities. That is called as immunization. Valuation of preferences follow the same pattern of that of debentures or fixed income instruments, and hence these are the present value of future preference dividends and redemption values. Bond refunding cases where you will probably repay the existing bond by taking a new bond, in which case you will consider the incremental cash flows or cash interest savings on this transaction, consider the flotation cost, call premium, etc., including the tax effects, and find whether it is worthwhile to return a bond or not. Multiple different alternative presentations can be possible for this particular case. Next, you go to the valuation of equity shares. The typical valuation of equity shares happens using the Gordon's formula, which is nothing but a perpetual geometric progression, which you calculate as P0 is equal to D1 by KE minus G, where KE can be calculated either using CAPM, RF plus RM minus RF into beta, or it can be calculated using other methods like dividend yield, earnings yield, etc. But typically we will calculate this using the CAPM. G is equal to R into B, where R is the rate of equity and B is the retention ratio. So this is a single stage growth model. However, the complexity over here arises that what if for a few years the dividends are expected to grow at exponential rates and then they are going to stabilize? Then you will have a multi-stage model where you will try to find the present value of future dividends wherever the dividends are growing at different rates, and then you will take the terminal value. While calculating the terminal value, if you have taken the 4 years dividend, and then if I want to find the terminal value from the 5th year, that is D5 by KE minus G, that will give you P4, and hence you will find the present value at the 4th year. You need to be a little careful over here. Okay, once you have done that, you go to a further point where we say that what is the problem in the multi-stage growth? Well, it is based on dividend, and dividend is discretionary, and hence we modified and mold the concept to take it to free cash flow. Free cash flow is a pool of money which is available for the providers of for the company to pay to the providers of capital. Now over here you have the firm concept and the equity concept. Firm or the enterprise is equal to debt plus equity, and hence the free cash flow to the firm is a cash flow before interest or before principal payments, whereas free cash flow to equity will be after interest and after principal payments. FCFF, that is free cash flow to the firm, will be discounted at WACC, whereas FCFE will be discounted at KE. So when you look at the calculation of FCFF or FCFE as a case may be, so first if you were to find, let us say the FCFE is as PAT, add back depreciation, you will not adjust the interest because it is FCFE, subtract fixed capital investment, subtract the working capital changes, and also change the changes in net borrowing. So if the data on debt repayments or borrowings taken is available, FCFE can be used. But if the data is not available and instead interest data is available, then you can use FCFF, where you say FCFF is the PAT plus depreciation into 1 minus depreciation plus, let us say, interest into 1 minus T minus fixed capital investment minus working capital investment. However, you will not adjust the debt changes over here because you are doing the free cash flow to the firm. FCFF will be discounted as back to give you the value of the firm, from which if you subtract the value of debt, you will get the value of equity. Okay, sometimes an alternative method can be used in case a debt ratio is given. In case a debt ratio is given, that is debt upon debt plus equity, then you can directly find the FCFE by taking the PAT plus depreciation into 1 minus D minus fixed capital investment into 1 minus D minus working capital investment into 1 minus D, and you don't need to separately adjust for the debt taken or debt repayment. The 1 minus D, D as in the debt ratio, will take that into consideration. There are a few alternative valuation models which I would say are not very important. First is the earnings yield, where you take P0 is equal to E1 by KE minus G, or the P multiple approach, where you find the implied PE ratio by calculating 1 divided by KE to give you the implied PE ratio, and that you will use for the purpose of valuation. In all of these cases, we will take the KE to be equal to R. KE is the required rate of return, R is the actual rate of return. In both of these formulas, institute takes KE to be equal to R, and hence we will take the same. There's a yield method where you find the value per share as the actual yield percentage upon the expected yield percentage into the paid up value per share. That will be the yield method. A few adjustments. Walter model, not very important. D plus R by KE into E minus D upon KE. The objective of Walter model is to actually suggest the dividend payment strategy rather than a share valuation. Usually for Walter, the general rule is if R is greater than KE, then you should retain, not pay dividend. If R is less than KE, you should pay dividend. If R is equal to KE, you are indifferent. Okay, efficient market hypothesis was given by someone called as Eugene Fama, who divided the markets into three categories. Weak form efficient, where he says that the market will consider the effect of past price and volume movements. Semi-strong, where apart from the past prices and volume, you will also consider the public available information. And then strong form, where you will also consider, let us say, your privately available information. And based on that, a few tests are there. Now these are highly calculative. Like there's a runs test and there is an autocorrelation test. There's also separate filters test, but let us say focusing institute sums have been on runs or autocorrelation test. So under the runs test, what can happen over here is you'll have a few steps. Find N1, N2. N1 is the number of positive sign changes, N2 is the negative sign changes, and R is the number of runs, that is the number of sign changes. So based on that, you will find mu and standard deviation. Apply that and calculate the limits. Lower limit is the mu minus T into the standard deviation value. Upper limit is mu plus T into the standard deviation value, where T is the value calculated based on the level of significance given in the particular question. If your R, that is the number of runs, is between the lower and upper limit, then we will say that the market is random, that is weak form efficient. But if the R is above or below that, we will consider that the market is not in the weak form efficiency because it is not as random. Okay, next you will have autocorrelation. Autocorrelation just means correlation with your own self. So if you have a data set of 20 days, you will divide into two sets of 10 days and assume these are two separate securities and try to run a correlation. If the correlation between the first 10 days and the next 10 days is high, that means you can predict the prices of the next 10 days, and hence we can consider that this is, let us say, a weak form or efficient, because you can predict the prices if the correlation is higher either on the positive or on the negative side. Okay, next you will have let us say some sums on technical analysis, where you look at past price and volume data, and in technical analysis you will have EMA, exponential moving average, where you will try to find an exponent which is calculated as 2 divided by n plus 1 as the exponent value, and then you will start with, let us say, a 30-day, 15-day, whatever it is, moving average, and then adjust it by the exponent adjustment, which is the exponent into the difference, that is the changes between the average and the current day spot price. So over here, current day EMA is equal to EMA of the previous day plus or minus the exponent adjustment, and you will keep on finding the exponential moving average. Typically, if the exponential moving average is rising, if that is kind of an up market, if it is falling, it is a down market. If you want to find a signal, if your actual price cuts the exponential moving average from below, we say that's a buy signal, and if your actual price cuts the exponential moving average line from the upward side, it shows as a down signal, sell signal. Okay, so calculation of post issue market price, sometimes it is calculated if there are new issues. You will consider the impact of the new issues, the pre-issue market cap plus the issue proceeds plus, let us say, NPV on the project divided by the post-issue number of shares. This will give you probably the market price post a particular issue. Sustainable growth rate, or G, is nothing but R into B. And in certain special cases like rights, you might be asked questions on X rights price, which is nothing but the theoretical post rights price. It is nothing but the weighted average price and value of right alone, which can be calculated in multiple ways. The more common way is the X rights, and the difference between the X rights and the cum rights price can be the value of the right alone. Sorry, the difference between the X right price and the right issue price will be the value of the right alone. In case of buyback, sometimes the buyback is out of surplus funds, and hence the number of shares falls, the profit remaining the same, and hence EPS goes up. If the EPS goes up, EPS into the PE ratio will give you the post buyback price, and depending on the required data you will do the workings. Share warrants are nothing but options. You might have various terms like theoretical or intrinsic value of the warrant or a warrant premium, for which you might have to do certain calculations. Then you look at convertibles. Within convertibles you will have conversion value, where you are looking at conversion ratio into the market price. That is the value that you will get if I were to convert the bond. Straight value, that what if the bond continues straight as a bond only. Theoretical value, that is nothing but the intrinsic value, which is the higher of the two. Conversion premium is the difference between the conversion value and the market price of the security, can be calculated in percentage per bond per share basis, let us say. Downside risk is the price, market price minus the straight value. By what value can the bond fall to? Even if the share becomes worthless, even if the conversion is useless, still it will fall down to straight value. Conversion parity price, that is the effective market conversion price. What is the price effectively you are paying for the share? That is the market price of the convertible divided by the conversion ratio. Then you have the income differential and the premium payback period. Within the income differential, you will take the annual interest per bond and then subtract the annual dividend. Premium payback period, how much is the premium that you are paying and how much time does it take to recover that kind of premium. So this is calculated as conversion premium upon the favorable income differential. And lastly, over here there is money market instruments. In money market instruments, these are typically short term instruments, can be call or notice money, which is a very short term money. Then you have treasury bills, which is issued by the government, maximum up to a 364-day tenure. Commercial paper issued by corporates. Certificate of deposits issued by bank. And then there is repo and reverse repo. The thing that you have to calculate over here is the return, which can be calculated or also called as bond equivalent yield or annualized yield, which is calculated as F minus P upon P into 100. Annualized basis into 365 by the number of days. This will give you the bond equivalent or the annualized yield. Sometimes the question asks you to find the effective interest, in which case you will apply the compound interest formula, that is 1 plus bond equivalent yield upon M raised to 1 into M. So over here you can find the effective rate of interest after considering even the compounding effects. A question might come on repo, reverse repo, in which case you will try to find the amount to be lent in the first transaction. That will be the clean price. Clean price is the X interest price, dirty price is let us say the cum interest price. So clean price plus the accrued interest will give you the dirty price, and that is the true price that you will get if I were to sell the bond, minus the margin if that has to be kept. That will be the proceeds that I will receive, and on that proceeds I will add the rate of interest as agreed under the repo transaction for the specified number of days, and that will give you the repayment value under the repo transaction. So that takes care of valuation of securities, probably one of the biggest chapter, at least when it comes to the variety of concepts and the instruments that are there. Next you go to mergers, which is a slightly more easier or manageable chapter. So when we are looking at mergers, there are various types of mergers like a horizontal, vertical, conglomerate, reverse merger, etc. The various objectives or benefits that a merger gives you, like synergies, diversification, expanding into new products, geographies, markets, etc. And the important part over here involves a calculation of post-merger market price and post-merger EPS. So the post-merger EPS is calculated as a post-merger PAT, which is taken as a total of pre-merger PATs of the acquirer plus the pre-merger PAT of the target plus synergy, if any, divided by the post-merger number of shares, adjusted by the exchange ratio wherever required. So your post-merger EPS can be calculated, and then to the post-merger EPS you can multiply the post-merger PE ratio. In case data regarding growth rates etc. is not given, then we will have to find the post-merger PE ratio, which can either be the same as that of the acquirer, or you can even adjust it to the weighted average PE, and accordingly you can find the post-merger market price. However, there would be certain questions where data would be given in terms of growth rates, that is after the merger the growth rates undergo a change. In such a case, it is imperative that you take the effect of those growth rates in the Gordon's formula and accordingly find the post-merger market price rather than directly doing post-merger EPS into post-merger P. Okay, over here Next you go to exchange ratio. Usually exchange ratio is calculated as a factor of the target divided by the factor of the acquirer, provided it is a favorable financial factor like market price, higher the better, EPS, higher the better, book value per share, higher the better. All of these are favorable financial factors. You would take, let us say, EPS of the target upon EPS of the acquirer to find the exchange ratio. If there are multiple exchange ratios and weights are given, you will find a weighted average exchange ratio. However, if one of those exchange ratios is based on an adverse factor like NPA, then you will take the NPA of the acquirer divided by the NPA of the target to find the exchange ratio, and you will use that exchange ratio for the purpose of your finding weighted average swap ratio. Okay, some questions ask you to find the exchange ratio in such a way that EPS is maintained or MPS is maintained. In such a case, one needs to remember that the exchange ratio in such a case will be based on EPS, or the exchange ratios in such a case will be based on the MPS. Sometimes the question asks you to do impact analysis, that is, what will be the post-merger accretion or dilution of EPS or MPS, in which case you will find the post-merger MPS or post-merger EPS and subtract it by the pre-merger EPS or pre-merger MPS as the case may be, and that will give you the gain or the loss as the case may be. Okay, next you look at the calculation of post-merger MPS when different growth rates are given. This, in my opinion, is a very important case where you will look at the current data of the target. Based on that, you will find the KE of the target based on the existing dividend, based on the existing price and the existing growth. That KE is assumed to remain the same, and you will find the intrinsic value of the target by taking the new growth rate. You will say that, well, if all else remains the same, the target will be re-rated, and I will find the revised value of the target by doing D1 by KE minus G based on a revised base. Okay, then you will find the post-merger market price as the pre-merger value of the acquirer plus the intrinsic value of the target divided by the post-merger number of shares, and that will give you the post-merger market price, and not just by assuming any particular PE ratios. Premium is calculated in case of a cash acquisition as a cash paid minus the pre-merger market value. In case of a share swap, you will try to find in general the post-merger market price. Based on that, you will find that how much are you effectively paying, and compared with the pre-merger market capitalization will give you the premium, that is the excess you are paying either in the form of shares or in the form of cash. Some questions try to evaluate the merger using the discounted cash flow technique on whether the merger is viable or not, in which case we will try to find the maximum purchase price, that is MPP, which can be from the firm's perspective or from the shareholder's perspective, but MPP will typically consider the present value of the future cash flows. These present value of future cash flows can be in the form of future operating cash flows, plus you might get some cash flows on selling unrequired assets, plus there might be some synergies. All of that together will be the maximum purchase price. This you will compare with the price that the shareholders or the providers of capital are demanding, and then decide whether the merger is viable or not. Okay, next you will have, let us say, the appropriate discounting factor. Typically, the best discounting factor should be the discounting factor of the combined entity, because post acquisition, what will be the weighted average cost of capital of the combined entity, that should be the best discounting factor. If that is not available, then for the acquirer, and then if it's not available, then for the target. There are certain alternative valuation methods over here as well, like comparable company analysis, where you will look at another listed companies and try to find their multiples and multiply it, like let's say their PE ratio, and then multiply it by your EPS to find the relative value. Or if your company has multiple divisions, you follow the breakup value or the chop shop approach, where you will take the value of each of those divisions, like you will take one of your divisions into the EPS of that division, or earnings of that division will be multiplied by the PE ratio of a comparable pure play division, and that is how you will find. Or you can even do precedent transaction analysis, where you are looking at similar transactions that have happened in the past and using multiples in that transaction to value the potential value of your company. If you are looking at precedent acquisition transactions, there will be control premium which will also be included in such valuations. Okay, then you have a concept of EVA, which institute typically asks you in the business valuation chapter, but if you look at your old practice manual, there have been some sums of EVA in the merger section, so we have put EVA over here. So technically it goes in the business valuation section. At the end of it, it will come in your paper. They will not ask you which chapter it pertains to. So when you look at EVA, EVA is calculated as NOPAT. NOPAT is net operating profit after tax minus the invested capital into the WSAC. So NOPAT is calculated as EBIT into 1 minus T, or it can be calculated as PAT plus interest into 1 minus T. And invested capital is debt and equity both, typically at their book values, into the WSAC, typically based on the book value weights. A couple of adjustments which the institute possibly asks includes, sometimes there are some unrecognized assets like patents which may not be recognized, that will be taken as a part of your invested capital, and while calculating WACC, that will be added along with the equity weights, because after paying debt, whatever are the assets will be attributable to equity only. Further, there might be cases where there is a provision for bad debts, in which case what the institute does is it calculates the NOPAT and then separately it adds the provision for bad debts. So the adjustment over here would be, you will add the provision for bad debts after calculating the NOPAT for the purpose of this calculation. Sometimes it also asks you to calculate MVA, that is market value added, where there are two approaches. One, you can try to find the total market value of debt and equity both, compare it with the book value of debt and equity both, or you find the total market value of only equity and then compare it with the book values of only equity, that is including share capital and reserves both. So by and large, this takes care of your mergers. Next, you go to portfolio. Now this is a formula driven chapter, a lot of formulae that you should be comfortable with. So first of all, in a single security, you will try to find portfolio represents a group of securities. Your objective over here as a fund manager is to either maximize the return at a given level of risk or minimize the risk at a given level of return. So that is what is the objective of a portfolio manager, for which you need to find the return, let us say, of a single security, which can be calculated as P1 minus P0 plus D upon P0 into 100. This is for a single period. If I want to do a multiple period return, then in a multi-period return, you can calculate this as doing a 1 by n, or you can even use a compound interest formula, though institute, at least in the mutual funds chapter, mostly uses a simple interest formula only. You can stick to that. This is the measurement of risk. If I were to measure the return in the return, this is the measurement of return. If I were to measure risk, you can use measures like range to measure the risk. However, the best measure is standard deviation, where you can calculate the standard deviation as under the root summation of x minus x bar the whole squared, that is the deviation squared, upon n. If there are probabilities, then rather than dividing by n, you will multiply it by p, and that will give you, let us say, the standard deviation of each of these cases. Okay, next you go to the portfolio concepts, where the portfolio return is the weighted average return, where the amounts invested for a single year question, the amounts invested at the start of the years are typically taken as weights, and in case of a multi-year question, the market values at the start of the period would be taken as the weights in general by the institute for the portfolio return calculation. A special case over here can be, what if you have short sold a particular item, in which case the securities that are short sold will have a negative weight, and accordingly you will do the weights in such a way that the total of weights ultimately come up to 1 only. Portfolio risk, a very important thing. Portfolio risk over here cannot be calculated directly as a weighted average. In fact, you will have to use it as the A plus B the whole squared formula. So A squared, that is W squared into weight into standard deviation x squared plus W squared y into standard deviation squared of y plus 2 of weight of x, weight of y, standard deviation x, standard deviation y, correlation xy. So when you look at the correlation xy, how do you calculate correlation? It is calculated as the covariance of xy upon standard deviation of x into standard deviation of y. So when you're looking at, let us say, covariance of xy, covariance is, instead of taking summation of x minus x bar the whole square, due to x minus x bar into y minus y bar divided by n. Covariance, remember, can be either positive or negative. Covariance has 3 formulae to calculate. One, you can calculate covariance using this formula, or you can rearrange the correlation formula. That is, correlation is actually covariance upon standard deviation of x into standard deviation of y. You rearrange it, that is correlation into standard deviation x into standard deviation y will also give you covariance. And again you will study a formula, that is beta x into beta y into variance of the market will also give you covariance. So there are 3 methods to calculate covariance. It is one of the most important points over here. Is the theory of dominance, where if there is a security which has a higher return at the same level of risk, that will dominate, or a security which has a lower risk at the same level of return, it will dominate, or a security which has a higher return at a lower risk will dominate the other security. So that is common sense, honestly. Next you have a 3 security portfolio, in which case you look A plus B plus C the whole squared formula, like A squared plus B squared plus C squared plus 2AB plus 2BC plus 2CA. And that same applies even for a 4 security, etc. Just that you will have more measures of correlation. Here you will have the correlation of A and B, then A and C, then B and C over here. Okay. Next you look at a minimum variance portfolio, not very important. So minimum variance portfolio will be weight of x is equal to variance of y minus covariance xy upon variance of x plus variance of y minus 2 times the covariance of xy. This will help you in finding the weights to get the minimum possible standard deviation inside a 2 security portfolio. If this is weight of one of the securities, for weight of x, I will start with the variance of y. The weight of the other security, that is y, can directly be calculated as 1 minus the weight of x. This formula can be applied in only a 2-security portfolio, and the drawback in this formula is it only considers the risk, does not consider the return. Okay, next you look at CAPM. So when you look at CAPM, there are two measures of risk as per William Sharpe, the systematic and the unsystematic risk. Systematic risk is arising due to non-diversifiable factors, whereas unsystematic risk is company-specific factors which can be diversified. Sharpe says that you should compensate an investor only for bearing systematic risk, and as a result, your KE can be calculated as RF plus RM minus RF into beta, where RF is the rate on a government bond, RM is the market rate on a similar market index, whereas beta is calculated as the sensitivity, which can be calculated as a systematic risk of the security upon the systematic risk of the market. Typically, beta over here will be the correlation of security with the market into the standard deviation of the security upon the standard deviation of the market. An alternative formula for beta can also be covariance of the security with the market upon the variance of the market. So these are various ways in which you can find the beta. Now, one needs to remember that the beta of a risk-free security is nil. The beta of market is always going to be 1, and if the beta of a security is greater than 1, then it is more riskier than the market. If it is less than 1, it is less riskier than the market. In certain cases, if your return on market is missing, you can calculate the return on market by looking at the price in the question. If that is not available, if there are exactly 2 securities, you can use simultaneous equation of CAPM and find the RM. And if there are more than 2 securities, in line with the typical question that the institute asks, you will take all the securities to constitute the market and accordingly find the RM. Okay. Next, you will have portfolio beta, which is calculated as a weighted average beta, weight of X into beta of X plus weight of Y into beta of Y. There's no squaring, there's no square rooting required over here. There are 3 types of lines that you need to study over here. One is the security market line, which is a graphical presentation of CAPM. Securities market line starts on the y-axis at RF and it slopes upward. The slope of the securities market line is nothing but RM minus RF. And all the efficiently priced securities as per CAPM will fall on the SML. If a security is undervalued, it will fall above the SML. If it is overvalued, it will fall below the SML. So that is the SML. Then there is a characteristic line. This shows the characteristic or feature of your beta statistic that you have calculated. So what you will try to do is you will try to calculate this characteristic line using the regression equation, and ultimately the characteristic line equation comes to X is equal to alpha plus beta M, where alpha is equal to X bar minus beta M bar. So these are things that you will have to remember in order to apply the characteristic line concept. And last is there is capital market line, where instead of taking beta, you will take the total risk of the security and try to find the return. Capital market line is the least important. Characteristic line in these 3 from an exam perspective is the most important. You have been receiving multiple questions on characteristic line. Then you have systematic and unsystematic risk. Systematic risk is nothing but the numerator of beta. So that is typically correlation into the standard deviation of the security. However, if you also have to calculate unsystematic risk, then you will have to square this numerator, and then the total risk in squared terms minus the systematic risk in squared terms will give you unsystematic risk also in squared terms. If you want to square root it, the unsystematic risk square rooted is called as random error. That is called as the error term. So one formula to find the systematic risk and unsystematic risk would be, for systematic risk, it will be correlation squared into the standard deviation of the security squared, or if you were to rearrange the beta formula, beta, and then you will multiply the beta with the standard deviation of market and square it. That can also give you exactly the same measure for the systematic risk. Unsystematic risk again is like the balancing figure. As we have discussed earlier, there are 3 ways in which covariance can be calculated, as you can see over here. And there are 2 ways in which portfolio risk can be calculated. The first formula that we studied over here was called as the Markowitz formula. The second formula is the Sharpe index formula, in which case you will take the portfolio beta. So you will take the portfolio beta squared into the variance of the market, will give you the systematic risk of the portfolio, plus weight squared of each security into the unsystematic risk in squared terms for each security, and that will also give you the exactly same portfolio beta. In general, you can follow the Markowitz model unless you have been given random error, etc., in which case you can probably use this model. Okay, performance evaluation is used in mutual funds. There is Sharpe ratio, Trenner ratio, and Jensen's alpha. Sharpe ratio is the return minus the risk-free rate upon the standard deviation. Trenner ratio in the denominator takes beta, whereas Jensen's alpha just takes the excess over the required actual return minus the required return. There is a new ratio which the institute has also added called as the Sortino ratio, in which case you will take again Rx minus Rf, and rather than dividing it by the standard deviation, you will take the downside risk, that what is the deviation of it going down, and the downside risk will be taken as a base for the purpose of Sortino ratio, and that is about it. Okay, next you will look at something called as arbitrage pricing theory or multi-factor model, where instead of a single factor, that is a market, you look at multiple factors. That can be inflation, that can be interest rates, that can be GDP, etc. And your return will be based on K is equal to Rf plus lambda, that is the risk premium of factor 1 into beta of factor 1 plus lambda of factor 2 into beta of factor 2, and so on, depending on the number of factors you have. Where the lambda over here is the risk premium, can be calculated in one of the two ways. One, it is like what you do in CAPM, that is you will take, let's say if oil is one of the factors, the return on oil prices minus the risk free rate. Exchange rate is one of the factors, return on the exchange rate minus the risk free rate is a lambda. Or it can be the surprise element, that is the actual minus expected. Which of the two should be taken depends on the facts of the question. If actual and expected data is given, then you take the surprise element. In case the expected data is not given, in which case you will have to do the risk premium approach. Okay, next you have something called as Sharpe's optimal portfolio. Now this is something which is a fairly detailed calculation, not very important from an exam perspective. In case you have to solve, it has never come in the past, but if you have to take, then you will first calculate the Trenner ratio, rank the securities in a descending order of the Trenner ratio, and then calculate the cutoff point using this formula. It's a fairly detailed formula, you can pause and see if you want to, and then the cutoff point where you reach the highest is the final cutoff point, and these are the securities that you will select for your optimal portfolio as per Sharpe. Last, you go to private company valuation. In this, an important concept which is also there in the business valuation chapter, which we use over here along with portfolio, is the geared and the ungeared beta concept. An ungeared beta is also called as the company level beta or the asset level beta, irrespective of debt and equity, whereas a geared beta or the relevered beta or the levered beta is like the equity beta. So over here what you will do is, if you are a private company like Parle-G, you will look at a comparable company like Britannia and find the beta from the market. Now that is Britannia's beta from the market, so Britannia's equity beta, but that is subject to Britannia's operating risk as well as Britannia's financial risk. So we will try to find the Britannia's asset beta. While doing so, you will use this formula, beta unlevered or asset beta is the beta of debt of Britannia into debt of equity ratio of Britannia plus beta of equity of Britannia into debt plus into equity by debt plus equity of Britannia. Unless otherwise given, the beta of debt is taken to be 0 because debt is virtually risk free, and hence you will find the asset beta. Now this is representing the operating risk of the biscuit industry, which is the same for Britannia and Parle, and hence you will assume that the asset beta remains the same. Once you assume the asset beta remains the same, that is also the asset beta for Parle, but Parle has a different debt to equity ratio, and hence you will apply the same formula, substituting the unlevered beta to find the beta equity for Parle, and that will be giving you the relevered beta. For example, Institute uses this formula to showcase that working. Okay, if a tax rate is given, wherever D is used, you will do into 1 minus T. Perfect. That takes care of portfolio. Then you have capital budgeting, various methods for you to apply capital budgeting, certain techniques like risk adjusted discount rate. You look at risk measures like standard deviation, coefficient of variation, and higher the risk, higher will be the risk adjusted discount rate for discounting the cash flows, or the certainty equivalent approach, where you will see how certain is it for you to, or what is the certainty equivalent factor. It's a 70%, 80%, 90% as the case may be for the cash flows, and that you will take for the purpose of your calculations. Then you have the probability approach, which is in my opinion the most important value, where you will try to find a standard deviation for each of the year's cash flows, and that standard deviation for each of the year's cash flows will be used to find the standard deviation of NPV. So over here there are 3 years, you can find the standard deviation of the cash flows for each of the 3 years, and usually the cash outflow remains the same. So the deviation in the NPV arises from deviation in the possible cash flows, but standard deviation of cash flow will of year 1 will arise in year 1, so there will be a discounting factor. Year 2 will arise in year 2, so there will be a discounting factor adjustment. So how do you do the workings for that? Well, there are 2 methods depending on whether there is a dependent cash flow or independent cash flow. If nothing is given, we'll assume that there is an independent cash flow, in which case the correlation between the cash flow of year 1 and year 2 is 0, or dependent cash flow, in which case the correlation between the year 1 and year 2 cash flow is taken to be 1. And as a result, if it is a dependent cash flow, you will directly take the standard deviation of NPV is the standard deviation of cash flow for year 1 into discount factor of year 1 plus the standard deviation of cash flow for year 2 into discount factor of year 2 and so on. But then if it is an independent cash flow, you will apply this formula where you will take under the root standard deviation of cash flow into discounting factor squared and so on for each of the years. Implicitly what you are doing is you are saying that the correlation over here is 0, and as a result if I were to apply the portfolio standard deviation formula, ultimately if the correlation is 0, this will be what you are going to be ultimately left with. Sometimes this is also called as a Hiller's approach. Okay. Then you have certain evaluations in case of abandonment options, real options, etc. That is done along with derivatives. Sensitivity analysis, scenario analysis. So when you look at sensitivity analysis, what happens in case of sensitivity analysis? Over here, you will change one of the factors, keeping all other factors constant. Now, Institute over here has done sensitivity analysis in different ways. They have changed it each factor adversely by 10%, or in certain cases they have taken how far is it to bring the NPV to a 0 value. This is the most popular thing. So if nothing is given, you can take the sensitivity in such a way that how far is a particular factor change to bring the NPV to a 0 value, or other methods as well. Scenario analysis on the other hand does not change just one factor, it changes all the factors at a particular point of time and finds, let us say, the worst case, the best case, the base case scenario, etc., which will be the scenario analysis. There can be other factors like repair versus replace. So you will try to find the cash flow if I were to repair versus I were to replace, or what is the optimum replacement time in replacing a particular machine, where you try to calculate the effective annualized cost, EAC, which is calculated usually as the NPV of the cash outflows divided by PVAF and the number of years where the effective annualized cost is the least, is what you will take for the purpose of replacement. In this case, Institute has done a couple of sums using a slightly inconsistent approach. In the exam perspective, you can take a single method that you are the most comfortable with and solve. There can also be a decision tree analysis over here, where you might have various decisions and you will have to be required to draw a tree considering all the outcomes, and accordingly at each possibilities try to find the NPV and decide whether it is going to be taken or not. So there are various miscellaneous topics. There's a separate video entirely shared for capital budgeting. You can refer the same for the numericals as well. Next, you have mutual funds. So when we go to mutual funds, there are two types of funds. There is the close-ended fund as well as the open-ended fund. In case of the open-ended funds, you are open for entry and exit whenever the investor desires, and this will happen at the NAV. So it is important that you know how to calculate the NAV. And in case of a close-ended fund, the entry and exit, let us say, cannot happen whenever you want. It will happen after a specified period of time. However, you are still allowed to, let us say, sell this on the stock exchange, as the case may be. These are the types of funds. When you look at NAV, the net asset value over here is calculated as the net assets, that is assets minus liabilities of the mutual fund at fair value divided by the number of units. That will give you the NAV, and there will be sums involving NAV calculation where you have to take the fair value of assets and liabilities. Certain items like cash, receivables will be added. Payables like fund management charges, if they are not yet paid, will be deducted, and that will give you, let us say, the NAV. Sometimes you might be asked to calculate the investor's return, which is the NAV at 0.1 minus NAV at 0.0 plus D1 upon NAV at 0.0 into 100. This is the same as a portfolio return calculation, but sometimes there may be certain complexities, like if there's a dividend reinvestment plan or a bonus plan, then how will you calculate the return over here? So if nothing is given, the plan is a regular income plan. However, if you see that the number of units are increasing, then you might have taken a dividend reinvestment option, in which case you cannot just do the working like this, because you're not getting dividend in cash. In fact, you're getting dividend in the form of units. So you'll quantify the dividend amount divided by the NAV on the date of dividend, and that will give you the number of units that you get in the form of dividend, and that will be considered. So your new units will be your total dividend divided by the NAV at the dividend distribution date. Other types of plan can include bonus plans, where bonus units are given by the company directly. Bonus ratio is typically newest to old ratio, or a growth plan where neither a dividend nor a bonus is given, but that plan appreciates the NAV quite well. Okay, there's a dividend equalization type of questions that can come over here. In dividend equalization, every new investor that comes in will have to, along with the NAV, bring in a share for the total income divided by the number of existing units, where they will have to equalize what the existing units have earned, and people who are going out or redeeming will get a share of the profits earned till that date divided by the existing units who actually earned those profits. So the dividend equalization is equal to the income earned during the period upon the existing units during the period, and this will be charged from new units coming in the let's say within the year, and it will be given to the units which are redeeming during the year. The objective of this is to ensure that the dividend is fairly given to each of the old and the new unit holders. Now there are three fund management strategies. One is buy and hold, which is very simple. You buy and keep it. Then you have constant ratio plan, where you will have a constant ratio like 50-50 for debt and equity, and you will keep on rebalancing them at specified dates, provided the NAV changes by a specified percentage. So you might track the monthly NAVs, and if the monthly NAVs have gone or the percentage changes about 10%, let us say, then you will try to rebalance. That is, you will bring it back to the 50-50 weight, but it is not necessary that you rebalance every time. How often you rebalance and what is the threshold, you will have to consider. Then you have the constant proportion portfolio insurance, CPPI. So under CPPI, you will determine a floor value below which your portfolio should not go. And let us say if your portfolio value is 3 lakhs and the floor value is 2,70,000, then 30,000 is a cushion. And that cushion, how much times of that cushion are you open to invest in the equity? There will be a multiplier. If nothing is given, multiplier can be 1. So over here, if the cushion is 30,000 and the multiplier is 2 times, then 60,000 can be invested in equity out of 3 lakhs, which means the remaining 2,40,000 will be in debt. Similarly, at each rebalancing date, you will again recalculate the cushion, again recalculate how much should be there in equity, and then keep on rebalancing under the CPPI. There is also a concept of load, which is not very popular in these days, but load refers to the money or additional charges. Like if I were to enter into a fund, at the time of entry, the fund might have to incur certain costs, and hence they might charge you what is called as an entry load, which is to be added to the NAV to find how much money has to be paid. Or when you are redeeming, in which case there will be a concept of what you call as an exit load, where you will be given how much is the charges to be deducted before you kind of exit. Apart from that, performance evaluation measures like Sharpe, Trenner, Sortino or Jensen's Alpha were discussed in portfolio and can have also application over here. Next, we have the smallest chapter over here, which is risk management, which has a fair bit of theory, but from a numerical perspective, the concept of VAR, value at risk, which is important. Here there are 3 parameters for value at risk. This is really helpful in determining the amount of your portfolio which is at risk for a specified interval. So let us say you will have to define the time interval, let's say 1 day, 4 days, 7 days, etc. Second, you need to find the standard deviation, because that is the average deviation that happens on that time interval, let us say on a 1 day. And then the confidence level up to which you need confidence, maybe 95%, maybe 90%, but most importantly from an exam perspective, it is usually 99%. And the Z value at 99%, one needs to remember, is 2.33. This is from normal distribution table, but like you know that pi is 2 or 3.14, whatever that is, here this number is 2.33. So that is what you can remember. So if you have to calculate the value at risk or VAR, that is calculated as the daily standard deviation first in rupees. Don't take this in percentage. You calculate the daily standard deviation in rupees, that is the portfolio value in rupees, into the standard deviation in percentage. Sometimes you might be given the individual securities standard deviation. You might have to calculate the portfolio standard deviation like you study in portfolio management. Use that portfolio standard deviation percentage to find the daily standard deviation in rupees into the Z value at 99%, probably 2.33, into the root of the days, and that will give you the value at risk. So that is about it for the value at risk. Usually there are other methods as well. This is a parametric method, which is the only method that institute does, but there can be other methods like historical method or simulation using Monte Carlo method as well. Now there's a chapter on business valuation. In this case, there is a fair amount of theory which kind of gets added, but from an exam perspective, at least on a practical sums perspective, for the new theory as well as the new possible simple numericals that can come, we have put a separate video, you can refer that as well. But in this particular chapter, there are various basic other valuation methods like the net assets value for valuing the shares, asset minus liability divided by number of shares, where these are taken using the fair value, or the earnings capitalization or the multiple approach, where you take the multiple into the particular value. So EPS into PE will give you, let us say, the price. Or you might look at the earnings capitalization, where you find the earnings. Earnings can be PAT. If you want to find the cash flow, you add back depreciation. If it's just profit, you will take PAT without adjusting depreciation and divide it by KE. Here there is a section where you have to study regarding the new alternative valuation methods. If I have this handy, so there are new valuation methods which include for distressed companies, for startups. So there are various methods for startups, like you have the first Chicago method, you have the score sheet or scorecard method, the venture capital method. Further, for distress firms, you will look at the average of the distress value and the DCF value, or you use the modified cash flows. ESG, environment, social and governance, is a very important factor, and on account of ESG there can be certain changes, for which I would strongly recommend that if possible, if you have not referred, you can just refer the small PDF or the theory section that I have shared. Again, from an institute study material perspective, they have just given you theories, they have not given you any sums. A lot of students requested that we want a numerical to have a better understanding, or even if required to address that in MCQs. So you can probably refer those concepts separately. If you have not done it earlier, I mean, you can just read the theory and you can proceed, and that should be sufficient. Even if you read the numericals, it will not take more than 10-15 minutes, but it will be a burden out of your mind. It is the very, very simple illustrations that I have kept for your understanding. You will get a very clear idea looking at the numericals more than looking at theory, is my understanding, but again you can decide. Okay, next you have the chapter on foreign exchange. This is one of the institute's favorite chapter and one of the most extensive chapters. Now, a lot of things over here, but even at this stage, a lot of times students find it difficult to identify the rates. Now, there is no single rule, okay, on how to identify rates. You should do it the way you are the most comfortable with. Like the bid and ask rates, you can always say that, okay, simple bid is the banker's buying rate, ask is the banker's selling rate. Which rate should you select? Well, it depends. We use the base currency approach. We say in the exchange rate quote, what is the base currency, and depending on that, you are deciding whether you as a customer want to buy the base currency, so the banker will sell the base currency and accordingly. Or some people convert everything into direct quote and then solve. That is also workable, no problem in that. Or some people do the trial and error method. They say, okay, we will do trial and error. We will take both the rates on our calculator. Whichever is giving me the higher cash outflow is the relevant rate, or whichever is giving me the lower cash inflow is the relevant rate. Because the customer will get the lower cash inflow, or you will have to pay a higher cash outflow. Whatever is comfortable, but that is one thing which you should have some level of comfort in your mind. Okay. Now, there are some features of the foreign exchange market. It's a 24-hour market, one of the most efficient markets when it comes, and it is generally an over-the-counter market where bankers and dealers deal. The common terminology: direct quote, indirect quote, notifications, etc. Sometimes when the rates are given like this, you need to be careful to see. These are SWIFT codes, market conventions. You need to see what it kind of signifies, like USD INR given to you at 70. That is actually rupee per dollar rate, for example. Okay. Then you have bid. Bid is the banker's buying rate. Ask is the banker's selling rate. The difference between bid and ask is called as the spread. That is the banker's margin. Cross rate is if there are multiple currencies. If you have rupees and you want to go to the Brazilian real, you don't have a direct rate. You go from rupees to the dollar and dollar to the Brazilian real. You typically arrange the rates in such a way that the intermediate currency, like the dollar, will get cancelled, rupee per dollar into dollar per the Brazilian real, and that will give you the cross rate. Now, an important thing that you need to remember is the inverse of the bid will give you the ask, and the inverse of the ask will give you the bid. So, but while you are doing so, remember, when you look at 40 and 50 ka rate, for the dollar, 40 is the bid, for dollar, 50 is the ask. But when you take the inverse, you will have rupees as the base currency. So 0.025 is the ask rate for the rupees, but 0.02 is the bid rate for the rupees. So it gets interchanged. Okay. Exchange rate determination theories, we said that the exchange is determined based on the purchasing power, and the reason why exchange rate should change, among other things, is the purchasing power changes, and the purchasing power changes because of inflation. So your exchange rate can be forecasted as F by S is equal to 1 plus the interest rate or the inflation rate of one of the currencies upon 1 plus the interest or inflation rate of the other currency. Now, what do you take in the numerator or denominator? The simple rule is depending on the exchange rate code. So if your exchange rate code is rupees per dollar, rupees inflation will be in the numerator, dollar inflation in the denominator. If it is Canadian dollar to the Swiss franc, then Canadian dollar inflation will be in the numerator, Swiss franc inflation will be in the denominator, exactly in the order of the exchange rate quotations. Okay. general and important concept over here is countries which have a lower interest or lower inflation rate will generally have a stronger currency in the forward market. Remember that. Okay. Interest and inflation goes in hand in hand. So if interest data is given, you will take that. If inflation data is given, you will take that. Okay, forward discount or premium as a case. Maybe forward discount or premium is calculated as F minus S upon S into 100. This is on the base currency. If you want to do it for other than base currency, it is S minus F upon F into 100. You have to take this on an annualized basis. So into 12 by the M, that is number of months, or 365 by D, that is number of days. Remember, the forward discount and forward premium is a percentage per annum concept, and you will record it on a percentage per annum basis. However, if you have other things like appreciate, depreciate, increase, decrease, strengthen, weaken, these are not percentage per annum numbers. These are flat numbers. And if it is given that rupees appreciates by 5%, that is not 5 over a 3-month period, that is 5% over 3 months. It is not 5% per annum. It is flat 5% over 3 months. Generally, interest rate and inflation rate, generally institute gives it on a percentage per annum basis, but unfortunately there have been certain cases where they have taken flat rates. We can't do much about it. If nothing is available, we will always take percentage per annum, because that is logical, and also maximum places institute has considered that. Okay. Next you have forward hedging. That is, you can look at a forward contract and use that as a base, let us say, for the purpose of hedging. Sometimes you might be asked to calculate the gain or loss if the transaction is hedged, or if the gain or loss if the transaction is unhedged. Generally, if you want to find the gain or loss due to hedging, ultimately due to hedging, you will find that what is the expected rate if you keep the transaction unhedged compared to the forward rate if you were to hedge, and the difference between the two is the gain or loss due to hedging. Sometimes in these questions there is a transaction cost, let's say a 2% transaction cost. One needs to be remembered that this transaction cost will be applied on the forward rate agreed between the bank. Don't wrongfully take it on the spot rate only. You will have to take it on the rate between you and the banker. So that will be, let us say, on the relevant forward rate. Okay, over here there are certain concepts of what you call as swap points. Swap points, sometimes forward rates are not given in forward rates, they are given, let us say, in points. Sometimes these points are in ascending order, so ascending order you will add to the spot rate to find the forward rate. Sometimes they are given in descending order. If it is descending order, you will deduct to get the forward rate, and you will generally equate the decimals, bid points to the bid rate, ask points to the ask rate, but you will equate it with the decimal. So over here, if you have 50.2575 and 51.5025 and you have 25 to 75. Now that is 0.0025 and 0.0075. That is how you will generally take. Okay. Next you have cover rates or square off rates. If you have taken a transaction and you want to exit that, move out of that, that is, you want to cover it. So over here you will take the offsetting position. So if you have taken a buy position, you will offset by taking a sell position. So that is a cover rate or a squaring off rate that you will take. Sometimes you might be asked to calculate arbitrage. In a 2 market, 3 market scenario, it is quite easy. You will see where you can make a riskless profit, and accordingly that will be your arbitrage. The complex part over here is a covered interest arbitrage, where you will apply the interest rate parity theory. You will compare the forward rate with the theoretical forward rate using IRP, and if that is difference, then there is a possibility of an covered interest arbitrage. And under covered interest arbitrage, you will borrow in one currency, convert and invest in another currency, and after that you will bring it back at the actual forward rate, and if there is a difference, there would be an actual gain or loss. Now there are various ways in which you figure out which currency to borrow. However, at this stage you can always do a trial and error method, because there is only one of the two possibilities which is there. So one of the two possibilities over here is using the covered interest arbitrage, one of the two possibilities which is there. Okay, so this gives you covered interest arbitrage. Next you go to money market operations, which is based on, let us say, the covered interest arbitrage principle only. So when we look at money market operations, over here you might be an importer who has to pay in the foreign currency, and as a result you have a liability in the foreign currency. So to protect yourself, you will create an asset in the foreign currency, that is, you will invest in the foreign currency. So if you are investing in the foreign currency as an importer, as a money market hedge, you will borrow in the home currency. On the other hand, when you look at an exporter over here would okay, if there is an exporter over here has a receivable in the foreign currency. So if you want to hedge, you will create a borrowing, that is a liability in the foreign currency. So if you borrow in the foreign currency, you will invest in the home currency, and you will apply the home currency deposit rate for that. So this will be your money market operations. Next we have leading and lagging. Leading refers to prepayment, lagging refers to pushing the payment. In case of leading, typically we do get a cash discount, because we are paying early. However, you will have to multiply this by the spot rate, and as a result, because the money has to be paid today, so you will get a discount. So 100 ka cheez, maybe you will have to get a 2% discount. You will pay $98, and on that $98 you will multiply, for example, at the rate of spot rate. However, you might not have the money today, or at least even if you have the money, you will have to make it comparable with the other options, and hence you will have to make an interest or a time value opportunity cost adjustment. Similar is the case with lagging, where you might make the payment beyond the defined terms, where you might be charged a further additional interest, which might have to be considered. Next, you have currency futures. In the core difference between a forward and a future is a forward is a customized over-the-counter contract where you get the desired tenure, desired maturity, whereas it is a little illiquid. But a future, on the other hand, is a standardized contract with set defined maturities, with set defined time frames and contract sizes. However, it is highly liquid and you can exit it whenever you want. Further, because they are exchange traded, the contract counterparty is the exchange, and hence the counterparty risk is quite less. But in a forward, there is a high counterparty risk because the other party can possibly default, and it is not an exchange. Now, the steps for solving a future question would be: first, you will identify the currency of your invoice and compare it with the currency of the contract. So, if your futures contract is in dollars and your invoice is also in dollars, it's a simple question. You will ask yourself, if you are an importer, you are going to buy the dollars, you will buy the dollar futures, select the maturity. The maturity selected will be the maturity that covers your desired due date and is nearest to that. Third, the number of contracts. You will take the invoice value in dollars divided by the contract size in dollars, and that will give you the number of contracts. Maybe in decimals, you round off to the nearest number, and then at the time of settlement, you will go to the spot market, buy the dollars in the spot market. That will give you the cash outflow in spot, and then plus or minus. Plus if there is a gain, less. Plus if there is a gain, less if there is a loss. The gain or loss in the futures contract, which is the selling price minus the cost price into the contract size into number of contracts. So this is quite easy. The problem will arise in case the contract currency does not match the invoice currency. Like your invoice is in dollars, but the futures contract is in rupees. In which case, your strategy will be depending on what you are doing in the futures contract. Now, future contract is in rupees, and hence your rate should be dollar per rupees. So you will say that, okay, if I am an importer, I need to buy the dollars. That means I need to sell the rupees, and hence my appropriate strategy should be to be sell rupees. The maturity will still be the maturity that covers the contract and is nearest. But when you calculate the number of contracts, again, you will have to convert, because the invoice is in dollars, but the contract size is in rupees. So you will convert the invoice into the equivalent number of rupees, and this will be converted at the agreed currency futures rate divided by the contract size, and that will give you the number of contracts. While you are doing the gain or loss calculation at the time of settlement, remember your rates are dollar per rupees multiplied by the contract size in rupees, and hence your gain or loss comes in dollars, but you are an Indian party, and hence you will have to convert into rupees, and this will be conversion happening, let us say, at the spot rate. So that is something that you have to be a little careful about. Okay, next we have netting and matching. Sometimes it might happen that you are an importer as well as exporter. It is a good strategy to net off your exposures and only take the forward or whatever hedging product you are taking for the net amount. Now, this is netting and matching in an importer-exporter case. You can also look at a multinational where you have payments to various group companies. You will try to convert all of them into the holding company's currency, net them off, and only do the net payment amounts. And lastly, in case of, let us say, intergroup cash balances, you might be facing a decision where is it appropriate to keep the cash balances in the respective countries, deposit or borrow over there, or pull it into one country and then deposit or borrow. Again, you will do both the options. Select whichever is giving you the best possible return and you will take that. Currency swaps. Swap refers to, let us say, exchange. Usually a currency swap is done because you might be a well-known company in India, but you want to borrow in US. There may be a well-known company in US, they want to borrow in India. You will borrow in your respective countries and then exchange the amount. That is currency swap. And the cash outflow in case of a currency swap, or the rate in case of a currency swap, can be calculated as the rate that you pay to your bank plus you have to the rate that you pay to your swap counterparty minus the rate that you receive from your swap counterparty. That will give you the effective cost. Typically, swap is done to reduce your cost, and hence after the swap, ideally your cost should be slightly lower. Currency options, there can be call, that is a right to buy, or put, that is a right to sell. Two types of options. When you look at currency options over here, you will have to look at three legs over here in case of an option. you will have some part of your contract which is hedged. So let's say there is a $364,000 contract. However, under the contract size, only 362,000 or 1,000 is getting hedged. The remaining remains unhedged. What is unhedged will be, let us say, at the spot rate which is given in the question at the date of expiry, and if that is not given, you might hedge it using a forward contract as well. But there will also be a premium. The premium over here is slightly important because the premium calculation in this particular case would be based on the amount today. So premium is typically to be paid today, and you will have to convert it into the appropriate currency and then do a time value adjustment as well. So there will be three legs that you will look. The starting things will remain the same. Your strategy, whether it is a call option or a put option, what are the various maturities, what will you take, all that remains the same. But when you're doing the settlement, you will look at three things: hedged portion, the unhedged portion, as well as the premium and the time value adjustment on that premium. Now, a very problematic case in case of forward is a fate of forward case, where there can be a cancellation, extension, which is fairly easy, but then there is early delivery and late cancellation, which is kind of a bit of a headache. So when you're looking at a cancellation, here you take the offsetting position. So over here, offsetting position for the balance and expired period. So if there was a 3-month contract and you decide to cancel it after 2 months, if you have entered into a forward buy, you will cancel it by doing a sell for the balance 1 month offsetting contract. However, if the cancellation is happening on the date of maturity, then you will cancel it by the offsetting, that is the selling spot rate. Okay, so this is regarding cancellation. Extension is nothing but cancellation plus a new forward contract. So you will cancel the existing contract plus you will enter into a new forward contract. So that new forward contract, the rate of the new forward contract would be considered. Early delivery and late cancellation happens as per the FedI rules. So in case of early delivery, you will follow 3 steps. First step, you will find the agreed forward contract cash flow under the existing forward rate. Second, you will take the swap cost adjustment, where if there was a forward agreed as a bank, you are agreeing to forward buy as a bank, then the money will receive early and hence you will do a spot sell. So there would be a spot sell and another forward buy. So there will be 3 steps. Step number 1 will be cash flow under the agreed forward rate. Second will be on the prevailing spot rate, and then you will enter into an offsetting position for the forward commitments. Let us say for the remaining period. So the adjustments would be the difference between 2 and 3 will be called as the swap cost, which will be recovered from the customer if there is a loss to the bank, which will be paid to the customer if there is a gain to the bank. And the difference between 1 and 2 into the interest rate would be the interest adjustment, which will be kind of paid to the customer if there is an inflow for the bank, and which will be recovered from the customer if there is an outflow from the bank. So this is swap cost, difference between 2 and 3 into the contract value. And then you have interest adjustment, is difference between 1 and 2 into interest into the days upon 365. A bit of practice is a must over here. Late or automatic cancellation as per rule 6 of FedI. Remember, the time gap now as per the revised rules is 3 days. Institute in November 23 is also asked with more than 3 days, but I believe that they have given credit because they have done error on their part. But ideally, the gap is 3 days for the automatic cancellation period. So over here, contract without instruction will be considered, let us say, for 3 days for the purpose of this FedI rule application. Now there will be 3 adjustments. First, once the date of once the original maturity is done, there would be a definite cancellation. There would be a cancellation, and the cancellation will be done in a similar way. You will compare the originally agreed forward rate with the offsetting rate. The offsetting rate over here would be the rate on the date of actual cancellation. So that actual cancellation can be today, or if the customer comes within 3 days, whenever the customer comes, that will be the relevant rate. Then you have a swap cost, which will be again dependent on the actions. Like if the banker had a position where it was going to receive the dollars and hence it had entered into a forward sale. Now in order to meet that, the banker will have to do a spot buy. So there will be a spot buy and then there will be a forward purchase. So that charges will also be recovered from the customer, and if there is a difference in the cash flow into the rate of interest into, let us say, 3 days by 365, that will also be recovered from the customer. In this particular case, it is a penal provision. You do it the way FedI has suggested, and this will be recovered from the customer if there is a cost, but if there's a gain, the banker is under no obligation to give any of this to the customer. Okay. Then there are a few other miscellaneous concepts involving GDR, Global Depository Receipts, where you will be asked probably to calculate the cost of the GDR. KGDR is similar to KE, which will be calculated using, let us say, the formulas for KE like CAPM, Gordon's formula, etc. Or you might be asked to find the issue price of the GDR and the number of GDRs to be issued, where you will take the total issue proceeds of the GDR minus, so your total issue proceeds of the GDR divided by the issue price. And the issue price, you will have to look at various things like the number of shares per GDR, the exchange rate, etc. And that will give you the adjustment for GDR. Then there is transaction exposure. There are three types of exposure, which is the transaction exposure, which is nothing but the gain or loss if the transaction remains unhedged. Translation exposure, which is just an exposure on books or on paper if a foreign currency trial balance or balance sheet has to be translated. Generally, people don't hedge for it unless they plan to sell the foreign operation. And lastly is the operating exposure, which is also called as economic exposure, which is the exposure that an entity gets if it were to operate in the foreign exchange market. The exposure over here would be transaction exposure plus or minus gains or losses due to changes in demand. Over here you might look at data like elasticity, etc. to find that what will be the overall value if there is a particular gain or loss on the changes in demand. Now there will be types of foreign currency accounts. There is a Nostro account, my account with you, Vostro, your account with me, or Loro, that is with a third party. The typical type of question that comes over here is you have to prepare that account where you prepare the cash position and the exchange position. In the cash position there is a debit and there is a credit, and in case of an exchange position there is a buy or a sell. So when you are looking at a cash position, a debit would be like a payment, like in a passbook, and credit would be like a receipt. So here only the actual cash transaction, spot remittances, spot payments, spot receipts, forward contracts actually settled, and cash payments will come. And then there's a currency or exchange position where you will take positions, like a forward buy will be put in the buy column, a forward sell in the sell column. But if I were to cancel a forward buy, it will go in the sell column. Bills will be, if I purchase the bills, it will go in the buy column. If bills are cancelled, it will go in the sell column. Draft is a payment that I am going to make. If the drafts are issued, it will go in the sell column. Drafts cancelled will go in the buy column, and accordingly you will get either an overbought or an oversold position. So these are the concepts which I am just touching upon in this chapter. Then you have the chapter on International Financial Management, or IFM, where you are going to do international capital budgeting, where you can do project evaluation using either the home currency approach, that is, you will discount the local currency cash flows at the local currency discount rate. In general, if nothing is given, your cost of capital is the local currency discount rate cost of capital. So what you will do is you will convert your foreign currency cash flows into your home currency using forward rates. If forwards are given in the question, you will take that, but if forward rates are not given, you will calculate them using the IRP formula and arrive at the forward rates. Get the NPV. If it is positive, accept. If it is negative, reject. Another problem over here can be if I were to solve using the foreign currency discount rate, in which case the cash flows will continue in dollars. However, your discount rate will have to be converted into the foreign currency discount rate, for which you will have to apply 3 steps. First, you will look at your local currency discount rate, which is a total of, so 1 plus K equals 1 plus RF into 1 plus RP in your own currency. We will say that when we are expecting 15%, why are we expecting? As a compensation for the risk-free rate, which is, let us say, 10%, and maybe the remaining after a few adjustments will be the risk premium. But the risk premium is linked to the project, which is the same unless given otherwise across the world. So the risk premium is assumed to be the same, and then that you use in a foreign currency setup. So you will say, okay, the risk premium of the rupee and the dollar is the same, and hence you will try to find the cost in the dollars. 1 plus the cost in the dollars is equal to 1 plus the risk-free rate of the dollars into the risk premium, which is also the same in dollars. This will give you the foreign currency discount rate, which will be used for the purpose of discounting foreign currency cash flows. Okay, now if you look at inflation in capital budgeting, typically the rule is you will the given discount rate is the nominal discount rate, that is after inflation unless otherwise given. Real is without considering the effect of inflation. So unless given otherwise, the cash flows are assumed to be nominal cash flows, which will be discounted at the nominal discount rate. However, if you are being given that the cash flows are real cash flows, typically you will adjust the inflation, convert them into nominal cash flows and discount it at the nominal discount rate, or you can convert the real nominal discount rate into the real discount rate and discount the real cash flows at the real rate. So basically real cash flows at the real rate or nominal cash flows at the nominal rate. If nothing is given, you will convert every cash flow into the nominal, that is after inflation, and discounted by the given rate, which is also unless otherwise given after inflation. Key adjustments in capital budgeting. If you see the institute study model, there are 3 fairly big case studies. From an exam perspective, at least from an AFM direct paper 2 perspective, I don't see such big case studies coming. So you can just touch upon the important adjustments over there. The type of questions that come are the smaller questions, which I think are similar to question 3, etc., or question 7 or 8, which are there in our material. You can refer that, and that is what is the relevant questions. So when you look at the key adjustments in capital budgeting, one needs to remember that if it is sunk cost or cost which is incurred in the past, you can ignore the sunk cost for the purpose of project evaluation, and that will not be considered for the capital budgeting perspective. If there are overheads which are existing overheads, they are generic in nature, not directly attributable, again you will ignore them for the purpose of capital budgeting. Only if there are directly attributable overheads would they be considered. Working capital is a very important adjustment. Working capital investment that you make will be a cash outflow. Working capital also may be affected by inflation, and then at the end there's a hidden adjustment of recovery of working capital, which is a cash inflow. But sometimes the company is sold at the end as a going concern. If it is sold as a going concern, the salvage value that you will get is value for the entire business, including the working capital, in which case there will be no separate working capital recovery if you are selling it as a going concern. However, if you are selling the fixed assets piecemeal, and then the working capital will be separately recovered piecemeal unless otherwise given. And then there is a modified IRR or MIRR, in which case what you will do is, this is a rate at which the present value of IRR is a rate where PVCO equals PVCI, but the problem over here is the reinvestment rate. When you look at the IRR workings in general, the reinvestment rate is assumed to be the same as the IRR, which may not be the case. This project may be a supernormal project. The money that I receive will have to be invested somewhere else where I earn the cost of capital. So in modified IRR, what I will do is, whatever cash inflows that I am getting in the project, rather than taking them to the present value, I will take them to the future value, and I will compound them at the cost of capital. So basically I will get the future cash flows at the end of the project life, compare it with the cash outflow, and the average rate that is earned will give you the modified IRR. And lastly over here, there's an adjusted NPV, where we believe that in a project the financing and operating things are 2 different things, and as a result the discounting rates used for the operating activities should be different from the discounting rates used for financing activities, and as a result your project evaluation will be done based on different rates for operating cash flows and different rates for financing cash flows. That is going to give you the adjusted or APV, as the case may be. Next we go to the chapter on derivatives and then to interest rates, and that gets done with our practical concept based revision. So we go to derivatives. Now derivatives are instruments which have 3 features. They derive value from an underlying. Second, the amount paid initially is nil or insignificant, and the settlement happens at a future date. 4 main types of derivatives we study, that is futures, forwards, options and swaps. So first we look at futures. In this chapter 2 very important things. One is index future hedging, and second is option valuation. So when you look at futures over here, you will look at theoretical futures price, which you calculate using the cost of carry model, which is F is equal to S into 1 plus R raised to N. Again, if I want to do it for 3 months, then F is equal to S into 1 plus R into 3 by 12 raised, there is no raised to N, it is simple interest. If it is less than 1 year, if it is for 6 months, F is equal to S into 1 plus R into 6 by 12 and so on. If dividend is received, then dividend is received during the intermediate period. You will have to subtract the dividend. If it is dividend received at the end, minus D. If it is received at the starting, minus D into 1 plus R into, let us say, whatever is the time period divided by 12. So this is your cost of carry model, which is used for the purpose of finding the theoretical forward or future price in case of a stock future. This can also apply to index future with dividend, but the difference between stock future and index future, like a Nifty future, is the index does not have a face value, and hence the dividend percentage over here will be a percentage of market value, whereas in stock future, unless otherwise given, dividend percentage will be a percentage of face value. Again, the face value over here, let us say, is rupees 10, you will take that, but in index future, this dividend will be a per annum number, because there are various stocks in the index, they can give you dividend at various dates. Long story short, in case of a stock future question, dividend is a percentage of face value. In case of an index future question, the dividend is a percentage of market price. Stock futures, the dividend is a percentage flat, whereas index future it is a percentage per annum. If it is asked, dividend is the only point of difference, otherwise stock futures, index futures work in almost the same way. when you look at, these are the differences. When you look at the strategy for index future hedging, again the strategy is same as the currency futures. First, you will identify the strategy, that is, if you are long the portfolio, that is, you bought the portfolio, you take the opposite position, that is, you will sell, that is short. How many index futures and which index futures to short? Well, the index futures that cover your intended horizon that you want to hedge, let's say 3 months, and they cover for at least 3 months. And if you want to find the number, you will take the beta adjusted value, that is a portfolio value, into the beta upon the contract size. Why? Well, because your stock and the portfolio might, your stock and the index might not move in the same tandem. So you take the beta adjusted value. So your number of contracts will be the equity portfolio into the beta upon the contract size. That will give you the number of contracts. And then the gain or loss on settlement would be, let us say, the gain or loss on the underlying portfolio, and compare that with the gain or loss on the index future. That will be calculated as the selling price minus cost price into the number of nifties per contract into the number of futures contract that you have entered into, and that will give you the total value. In either of these cases, there can be a continuous compounding, and if there's continuous compounding, instead of doing f is equal to s into 1 plus r raised to n, you will do f is equal to s into e raised to rn, where e is 2.71828, r is the rate of interest, and n is the number of years. If it is 6 months, that is 6 by 12, that is 0.5, will be taken as a base over here. Okay. So this is in case of index futures. You will take, if it is index futures with dividend, f is equal to s into e raised to r minus d into n. There are some ways in which you can find log in the exams. We have discussed one of them. There can be other ways as well. You can do it directly on your calculators by adjusting by 19, 12, 15, whatever method you have studied. Commodity futures, unlike equity futures, will not give dividend. However, there will be a storage cost. So you will add the storage cost on the commodity futures and subtract the convenience yield, if any, in case of a commodity future. So the theoretical futures price will be the spot plus the cost of carry plus the storage cost, time value adjusted, minus the convenience yield. There can also be cases of margins over here. If nothing is given, there will be an initial margin which is calculated as the average absolute change plus 3 into the standard deviation of these changes. That will give you the initial margin, and maintenance margin is typically around 70 to 75% of the initial margin. That is a maintenance margin. The moment your margin falls below the maintenance margin, you have to replenish it by investing through a margin call and bring it back all the way up to the initial margin. Okay. Next you go to options. In case of options, again there is call and put. Call is a right to buy, put is a right to sell. Call option will be exercised if the spotted expiry is greater than the exercise price. Put will be exercised if the spotted expiry is lower than the exercise price. There are two types of options: European options, which will be exercised only at the time of expiry; American options, which can be exercised at any time up to expiry. Options are in the money if they are highly likely to be exercised, out of the money if they are not going to be exercised, at the money where the exercise price and the spot price are equal. Payoff refers to the spot price, let us say at expiry, minus the exercise price in case of a call option. It can be positive or 0 for an option holder. It can be negative or 0 in case of an option writer. However, if you have to calculate net payoff, that is a payoff minus a premium for the option holder, where the net payoff can be positive, negative or nil, and for an option writer it will be the payoff plus the premium, because the writer receives the premium, and hence again this can be positive, negative or even nil. So over here, these are a few key terms, a few strategies. Call options, one, remember, has to be a bullish strategy. So if you're long call, you are having a bullish position. If you're a long put, you are having a bearish position. There can be certain strategies like straddle, strangle, strip, strap. Not very important from an exam perspective. Straddle is one call, one put. Strip is one call, two puts. Strap is two calls, one put, and strangle is one call, one put, but at different exercise prices or at different maturities. So there are a few strategies, not very important from an exam perspective. What is important is option payoff and option valuation. Option valuation can be done using the intrinsic value or the theoretical option value, in which case you will compare for a call option spot today, not spot at expiry, spot today minus the present value of exercise price for a call option, or for a put option it is the exercise price, present value of exercise price minus the spot at expiry today in case of a put option. This is helpful in a way that it is a simple method. You don't have to predict the prices. It is based on the price today, but this is not very effective because the option is going to be exercised at a future point, and hence it is important that you predict the spot at a future date. For which other important methods like the binomial method, and Black-Scholes method are possible. So binomial method, as the name goes, will have two possibilities. Binomial, where you will be given a price of up move or down move, which can be used by various methods like your predictions, standard deviation, etc. Now there are two core ways in which this can be found. The risk neutral probabilities approach, which is the most easiest approach in my opinion, or also called as a risk-less hedge approach, where you create a hedged position of let's say of a share, and let us say shorting a call option, which the institute also calls as a binomial approach. An extra method is also possible, which is called as a replicating portfolio, which will be done only if it is specifically asked. So if you are looking at, let us say, the risk-less hedge approach, in case of a risk-less hedge approach, you will create a portfolio comprising of a long share plus a short call option. And because it is a hedged position, then after a particular interval of time, the portfolio will give you equal values, and hence we can find the hedge ratio. That hedge ratio you can use and find the portfolio value, that is how many shares should you buy for every call option sold. You will find the portfolio value, let us say after a time interval, but because it is a hedged position, it will earn a risk-free rate only, and considering that risk-free rate, we will find the value of the investment today, and based on that find the value of the call option, best understood with the problem only. Risk neutral probability is the most easiest way, where we kind of consider that the value of a share is the present value of the future spot prices. So P into the spot price into at an up move into 1 plus 1 minus P into the spot price on a down move into 1 plus R. So that will give you the P and 1 minus P. You will use that to find the value of the call option at possible call payoffs, and accordingly find the value of the option using the risk neutral probabilities. There is also a replicating portfolio approach, not very important from an exam perspective, where you create a portfolio comprising of let us say shares, and let us say you take borrowing and you do a portfolio which mimics the payoff of a call option. Okay, if there's a multi-period binomial, you will use the risk neutral probability, start from the right hand side and then come closer and closer to the value today. You will not directly do the valuation at each nodes. If it's an American option, the valuation will be the same as that of the European option, just that at each intermediate as well as initial nodes, you will compare the value with the possibility of immediate exercise and select whichever is higher. There's something called as a put call parity theory, where the put plus the spot price today should equal to the call plus the present value of exercise price. This is a very handy tool, especially in case you want to find the value of the value of the put option, and if you know the value of the call option, the exercise price and the spot price, you can directly apply the call put parity and find the value. Okay, next you will go to Black-Scholes model. This is a highly numerically intense method. Thankfully does not come as often in the exam, but if you look at the Black-Scholes valuation method, this considers everything: the spot price, the exercise price, the volatility, which was not considered earlier explicitly in the binomial method, time and rate of interest. Considering all of that, this is the formula: C0 is equal to S0 into something called as ND1 minus exercise price present value using continuous compounding into ND2. So when I'm looking at D1 and D2, I need to find the natural log of S0 by XP. So over here, the first step is to calculate the natural log of S0 by XP and use that for the D1 calculation. The D1 calculation is this big formula: D1 is equal to the natural log of X0 plus XP plus R plus variance by 2 into T divided by standard deviation into root of T, where T is the number of years. So if it is 3 months, 3 by 12, that is 0.25 will be T. R and standard deviation will both be taken in decimal terms. So if it is 22%, it is 0.22 for example. Find D1, then find D2, and once you have found D1, let us say, and D2, you will find the normal distribution value. The normal distribution value will be from the left tail. So you will try to find the value from the left tail to D1. If D1 is positive, it is plotted on the right hand side of the mean. If it is negative, it is plotted on the left hand side of the center, that is 0, and accordingly you find the ND1 or ND2 values. Then step number 4, you do E raised to RT, and then once all the ingredients are found, you will apply that in the binomial model formula to find the value of the option using the Black-Scholes formula to find the value of the option using the Black-Scholes. In case put option is asked, you will apply call put parity and find the put option value. In case dividend is given in Black-Scholes or in binomial, you will try to find the present value of the dividend and you will deduct it from the spot prices and do the valuation based on the X dividend spot price. Then you have the option Greeks. Option Greeks would involve the sensitivity of the option premium to the core factors like delta shows the sensitivity of the option premium to a 1 unit change in the share price. Vega shows the responsiveness of option premium to a 1 unit change in the volatility, V for Vega, V for volatility. Rho shows 1 unit change in option premium to a 1 unit change in rate of interest, R for rho, R for rate of interest, and T for theta, T for time. So these are option Greeks. Delta, sensitivity to share price. Movements, Vega, sensitivity to volatility. Theta, sensitivity to time. Rho, sensitivity to rate of interest, and gamma is like convexity. So as share price keeps on changing, the delta keeps on changing. So the rate at which delta changes is called as the gamma. Over here, usually you might get an MCQ, not a full-fledged question on option Greeks typically. A few new theory points have been added in derivatives like exotic options, which can be chooser options, compound options, etc., for which we have shared some theory videos separately. You can refer that. Credit derivatives can be collateralized debt obligations or a credit default swap. A CDS or a credit default swap, for example, will be something where you will someone will write, let us say, write in case of a CDS a guarantee that if they will not default, and if they default, they will pay you, the writer of this CDS will pay you money. So over here, this is like a protection from default. Then you have weather derivatives where the underlying is like the weather, electricity derivatives where the underlying is electricity, and then you have real options, 3 particular sums on real options for which you have shared a separate video. Abandonment option, growth option, as well as real options can be reviewed over here. So there would be growth options, abandonment option, where it's like a put option if you want to exit a project, and there will be timing options, that is you can get an option on when do you want to start or execute a project. These are called as real options where the underlying is a project. In the last chapter over here is interest rate risk management, where you have 4 products: interest rate futures, where these are notional bond futures where you will have the bond price is quoted as 100 minus the rate of interest, and the typical quoting is in terms of months. So it's a 3-month September futures, which means if you want to take a borrowing or deposit in September for a period of 3 months, that is a September 3-month futures. The strategy over here is, if you are a borrower, you typically issue or sell the bonds, and hence the strategy will be to sell. If you are a lender, you will buy the bonds, and hence the strategy will be to buy. The settlements over here, again, when you will do, before that you need to find a number of contracts, and in case of the number of contracts calculation, you will take the loan amount into the number of months of the loan divided by the futures contract size into the number of contracts on the futures, and that will give you the number of contracts. Then you will look at the settlement, which is the selling price minus cost price. Over here, this is the notional bond prices in percentage into the contract size into the number of contracts. So while doing this, you need to remember that you multiply by the time period as well, because this is an interest rate adjustment which is to be done. There can be a cheapest to deliver bond question which can come, whereby you will be given a conversion factor to convert these bonds. So basically, if you want to find the value, you will convert the bonds into the conversion factor, and whichever bond is the cheapest will be the bond that you will select as the cheapest to deliver bond in case of a interest rate future. In case of a forward rate agreement, here there is no notional bond. You will directly enter into contact with the banker. If you are a borrower, you will pay interest, you pay things, you pay money for things you buy, and hence you will buy. If you are a borrower, if you are a lender, you will receive the interest, you receive money for things that you sell, and hence a lender will sell the interest rate. The notation over here will be, let us say, if you want to borrow after 3 months for a period of 6 months, the notation will be 3/9, that is borrowing after 3 months for a period of 9 minus 3, that is equal to 6 months. A time value adjustment will be done over here. Generally for futures, institute does not do any time value adjustment. For FRA, again, if they have to compare with futures, no separate time value adjustment is done. But if it is a standalone FRA question, institute sometimes does a time value adjustment to bring the settlement amount, which is actually on the ultimate repayment date, back to the reset date. Okay. There is forward rates which you studied in valuation, and that can be used for the purpose of determining arbitrage on whether you want to if there's an arbitrage opportunity available or not. Then you go to interest rate options, where there is a cap which is typically taken by the borrower. which caps the interest rate, a floor which is taken by the lender for the minimum interest rate in case of a floating rate, and a collar which is a combination of cap and floor in order to kind of minimize the transaction cost. There can also be an interest rate guarantee where someone is providing you guarantee in return for a premium. A cap will be exercised if the interest rate is greater than the exercise price. A floor will be exercised if the interest rate is lower than the exercise price. And time value adjustment can be done in case you want to find the payoff considering annualized premium, where you will take the premium divided by the PVAF of the remaining periods to find the annualized premium, adjust it with the payoff to find the net values. Okay, next you have something called as swaps. Over here you might be asked to design a swap where you might first try to find the cost savings, comparing the total desired borrowing cost with the borrowing cost under swap. If there is a saving, that saving can possibly be shared between the parties, and if there's a swap bank, there might be some allocation given to the swap bank. The savings will be shared typically unless otherwise given on an equal basis, and you will find the net cost of the borrowing, which will be the base for the purpose of designing a swap. Typically the fixed leg can be taken as X, and based on that you can find the equation and find and design the swap. You will need some practice for this. There are two types of swaps. There is a generic swap and a OIS or an overnight index swap. In case of a generic swap, typically the settlement happens after every 6 months. The settlement happens based on 30 by 360 rule in case of a fixed rate, whereas actual by 360 rule in case of a floating rate is what the institute does. And in case of an overnight index swap, the effective settlement is looked at on a daily basis. You will look at the floating rate on a daily basis, and you will consider the floating rate reset for each working day. For a non-working day, you will continue to take the rate of the prevailing date for the purpose of the calculation. Again, best if you kind of do some practice on this. So over here we could not do it in 1 hour, probably we took some time more, but I hope I've kind of managed to give you an overview of the entire practical section. I'll see you soon, hopefully after a very good AFM paper. Wish you all the very best. Good luck, take care and study hard.